It's time we answer a question on your stock in a little segment we like to call Your Stock, Our Take. Buy, sell, or hold.
Innergex Renewable Energy. So this was from an email from Brian. He asked us to take a look at the company. He mentioned that the stock has been hammered pretty hard over the last year. It pays an attractive dividend, and he wanted to know, is Innergex a buy? So let's take a look at the company and give our thoughts on it. Innergex Renewable Energy, the symbol is INE, trading at just under $15 a share right now. It's a $3 billion market cap company, and it does pay an attractive yield of just under 5%, 4.9%. So what do they do? Innergex Renewable is an independent renewable power producer based in Canada. The company has a portfolio consisting of about 3,500 megawatts of hydroelectric, wind, and solar facilities in Canada, the United States, France, and Chile. So they have a global reach right now, but they're primarily still in North America in terms of the majority of their portfolio. Canada makes up about 51% of the portfolio, and the United States makes up about 33%. Now, the stock has really done very little for investors over the past 5 years. If you take a look at a 5-year chart, the stock price has been actually very volatile. At one point, it had hit a price of $32. That was in early 2021. But over the past 5 years, it hasn't really moved that much. It's come down about 30% over the last year, and right now trading at about 1460. So down by more than half relative to its recent high. And this was during a period where renewable stocks were very popular with investors, and there's a lot of buying in that market. But most renewable stocks right now, particularly the large ones, are going to have stock charts which don't deviate too far from this. Most have not performed well over the last year, although many have performed at least better over the last 5. Taking a look at the company's recent quarterly results, the results looked very strong pretty much across the board. 34% growth in revenue, 34% growth in adjusted EBITDA. Now, earnings per share, even on an adjusted basis, were negative, but cash flow showed very strong growth. 43 cents per share in cash flow for the second quarter of 2022 compared to 24 cents last year. So that's growth of about 80%. And the company has also put out targets for the current year and guidance. They're expecting to grow their production 22%, grow their revenue 25%, their adjusted EBITDA 25%, and free cash flow per share is expected to come in at about 75 cents, also growth of 25%. Points for consistency. So the recent results and the guidance for the year look very strong. But if we take a historical perspective on Innergex, the results are not as impressive. And in fact, one thing that I've noticed, because I have looked at the company several times in the past, is that in spite of the fact that it's an extremely acquisitive company, they spend a lot of money on making acquisitions, they really have not done a good job historically of growing their cash flow per share or their free cash flow per share. So, some volatility, a lot of flatness. We did see, a small amount of growth last year on a per share basis. And then this year, they're expecting 75 cents, as I said, up from 60 last year. So this year, if they're able to hit their targets, growth should be good. But historically, we really haven't seen an established track record of growing on a per share basis. And per share growth is really one of the most important metrics that we look at. Because you can grow your revenue, you can grow your EBITDA, you can even grow your free cash flow on an absolute basis. But at the end of the day, as an investor, you own shares. So if that cash flow isn't growing on a per share basis, you're not likely to get ahead long term. Company does have a 5-year growth plan, which they started in 2021, running out to 2025. So they are expecting to have good, consistent growth over the next couple of years, and they're targeting free cash flow per share of about $1 by 2025, and as well as improvements in the payout ratio and improvements in the debt leverage as well. So that would be about 30% growth over the expected for the current year between 2022 and 2025. Not bad for what's essentially a utility company. Now, one thing that's always come up with me when I've looked at Innergex in the past is the balance sheet. I've always considered them to have a fairly debt-heavy balance sheet, a lot of leverage. This is because they're, on one hand, a utility. It is a capital-intensive business. but they're also very acquisitive and they use a lot of debt to make acquisitions. So net debt to EBITDA of 10 times, debt to equity of 4.3. I consider that pretty leveraged, although one thing I will say about utility companies, because they have contracted cash flow, they can generally hold more debt and higher leverage ratios than other types of sectors where there's less visibility in terms of the cash flow that they're going to produce over the next couple of years. I also will note that in the past, when I've looked at the company, Innergex's leverage ratios were higher than most of their comparables, which would be independent power producers in Canada and the United States. Although I've noticed leverage ratios tick up in some of the comparables as well. So amongst a lot of the companies that you would consider their peers, you're going to see, relatively high leverage ratios. Net debt to EBITDA 10 times, I consider that quite high. What I would consider to be a more ideal multiple for a company like this would probably be 6 to 7 times. And then valuation based on the current share price, based on the company's targets for this year, you're looking at about 20 times on a price to free cash flow basis. So I don't consider this to be particularly cheap or particularly expensive. It's probably right around fair value in the near term. Now, if they're able to achieve their growth objectives over the next couple of years and generate that dollar in free cash flow per share, the valuation really starts to improve and things look better. But based on their current level of free cash flow, I would say that this is reasonably valued, maybe even slightly more expensive than I would want to pay in this market. So, what are the pros and cons of investing in Innergex renewable energy? Well, starting with the pros, we do like the renewable power space, and Innergex has been growing its portfolio. So, long term, there's the demand, there's growth in renewable power. It has stable contracted cash flow. So, certainly in the event where we enter into a recession, we wouldn't expect a company like Innergex to be impacted nearly as much as most companies in the market. Really high visibility cash flow. Of course, this supports the dividend, sustainable dividend. They have an attractive yield of 4.9%. There is potential that the dividend is going to start to grow again. And the growth in cash flow per share. There was a little bit of growth in cash flow per share last year, and that seems to have accelerated this year. So that's a real positive check mark in the company's favor if they're able to maintain that. That's really what we think Innergex has been missing over the past half decade or so. The cons, that poor track record of growth in per share cash flow. So they really haven't established a track record, while other companies in that space have had a better one over the long term. So although it does appear that that's changing, we can't be completely confident that the company's MO is going to change. There's always the possibility as they're trying to achieve their 2025 target, that they decide to invest more aggressively in something else, which they then say is going to delay the growth in per share cash flow. So we would prefer to have seen more of a long-term focus on the per share numbers. There's a high dividend payout ratio currently and no recent dividend growth. So their payout ratio, depending on which one you look at, is about 90% of free cash flow. We would consider that high, and no growth really in the last couple of years in the dividend. There's the high leverage on the balance sheet that we discussed, although that's not completely out of line with the peers. And then there's the valuation, not particularly cheap, not extremely expensive, maybe fair value, maybe a little bit above. So finally, what is our take on the company? Well, we do believe that it's a stable company, good renewable power generator, growth by acquisition over time, potentially. We would really primarily own it for the dividend in the near term. If you're going to make the decision to invest in this company, that'd kind of be the base rate expectation, would be getting that about 5% yield, and then hopefully some dividend growth in the near future. They should be able to produce growth over time through their acquisitions. That's still yet to be seen, though, if they're going to be able to hit their targets. Right now, things are looking good in 2022. We would really watch those per share growth figures, though, because as I'd said before, it's one thing to make a target. It's another thing to, make some progress towards that target in a single year. But we have seen it many times in the past where companies have made long-term targets, and then halfway to that target, they've readjusted and they said, you want to know what? We see opportunities to invest more in growth now, so we're not going to worry about the per share numbers. And we don't like that. We want to see the dividend grow, and for the dividend to grow sustainably, the underlying adjusted earnings per share and free cash flow per share have to grow, and not just the overall free cash flow. So Brian's question was, do we consider this company a buy? I think income investors could buy it. I don't think that there's anything glaringly wrong with the company, but I would take a long-term perspective. I wouldn't consider this, a near-term buy. I'd take a long-term perspective on it. Buy it for the dividend, maybe start small and increase the position slowly over time as the company starts to hit their targets. But if you enter in with that base rate expectation, dividend, maybe resumption and dividend growth, then any capital appreciation really just becomes extra. So for me, it's not really a buy recommendation, something that I would want to rush out and recommend as a buy. But for somebody who wants to get a nice dividend yield, it's something that they can consider. But we would just, generally speaking, looking at this right now, we would probably just consider it a hold and something that we would monitor. So that is my conclusion on Innergex.